Hello everyone, welcome to PS Perspectives. I'm Colin Callahan, product specialist here at DoubleLine. And throughout the course of the year, in conversations with clients, my colleagues and I have heard a consistent theme that investors are allocating capital towards money market funds and T-bills. And it's easy to see why. The yield on T-bills have increased from about 3 basis points in the beginning of 2022 to just under 5.5% today. And it's hard to argue against moving money into T-bills today, given the macro uncertainty, potential recession looming. And on the screen here, you can see that assets in money market funds have swelled to just over $5.6 trillion, about 20% growth year to date. Now, with that said, we at DoubleLine think there's a strong case to be made to potentially allocating away from T-bills and money market funds and into a broader fixed income portfolio. And we've run an analysis that makes that compelling case, and I'm going to walk you through that now. So let's dive in. So on this slide, you can see the market implied expectations for the future Fed funds rate. And today, into year end, it looks like we're facing maybe one more hike to the Fed's funds rate. And looking out to the end of next year, the market's pricing in 100 basis points of cuts. So we could be nearing the end of the Fed hiking cycle based on current market pricing. Looking at this slide, you will see the past 3 recessionary periods, and you can see if you start on the left-hand side that the Fed hikes up into and right before each recessionary period, and then during those recessionary period, it will begin to cut rates. And if you move your eyes to the right-hand side of the screen, you can see that the Fed has continued to hike since March of 2022. They've hiked 11 times, and we might be potentially at the end of the hiking cycle already or moving into the end of this year. So now let's take a look at that analysis that I mentioned earlier. So I mentioned those 3 previous recessions. Now, what we've done here, and I'd like to focus your attention on the right-hand side of the screen, is that after the Fed has paused, we've taken those 3 periods and averaged out the returns for 3 years out from each pause. And what you can see here is that broad fixed income has vastly outperformed the 3-month Treasury bill. When you look at the ag, it's about triple the return of the Treasury bill. And when you look at short-term fixed income indices, it's about double the return. And so moving on to the next slide, what we can see here is the same analysis where we've studied the previous 3 recessions, but starting with when the Fed made that initial cut. And so on the right-hand side here, the 3-year averaged annualized return significantly outperforms the Treasury bill. So for example, the ag has more than triple the return of Treasury bills, and short-term fixed income indices have double the return of Treasury bills. So again, to reiterate, we understand why investors are allocating to Treasury bills and money market funds, given that an increased yield relative to history and with the macro uncertainty that's out there of a potential recession looming. However, using history as a guide based on the past 3 recessions, we think that today is the perfect time to potentially allocate to broader fixed income portfolios, given that the Fed's hiking cycle has been long in the tooth. If you're interested in learning more on how to allocate with DoubleLine, visit us at doubleline.com. Thank you.